What's up, guys? I'm Nobody Special, and interest rates on the benchmark 10-year Treasury yield have recently broke 1.5%. That's a major milestone, and it looks like they're heading higher. We're going to talk a little bit about why they're going up and what that means for the rest of the economy and what we might be looking at in the coming months. You ready? Hit it. Thank you for joining me. I'm Jack Gamble, and I'm Nobody Special. And interest rates are climbing. They're rising fast, spiking over 1.5% this week. It looks like they're continuing to rise, and that is not necessarily good news for the American economy. We're going to talk a little bit about what that means and what we might be seeing in the coming weeks. Before we do that, guys, I have to ask you, could you please click on that transitory like button, subscribe to my channels, hit that notification bell. It would really help me out, and I would be forever in your debt. Now, let's shrink my big fat melon of a head and get into this story. So here we have interest rates on the benchmark 10-year Treasury bond. All right, now, real quick refresher, you have to remember when you see Treasury yields going up, that is Treasury bond prices going down. Prices and yields are inversely correlated. So as we see these yields rising, what we're seeing is a sell-off in bonds. People are dumping their bonds, driving prices down and interest rates up. Remember that. Okay, so here, let's look at the chart a little bit. Let's bring this up to a full screen. Put it at a one-year chart. Let's make sure I am not in your way. Of course I am. And there we have it, our one-year chart. And you can see, we started the year quite a big run at the beginning of the year, and then we had a little bit of a sell-off through the early part of the summer. We've been kind of bouncing around all summer with all the talk. Will they taper? When will they taper? Are they going to taper? They're finally going to taper. They're going to taper a little bit. And now, a few days ago, we had the Fed speech where Powell basically laid out the timeline saying sometime around November we're going to start the taper. It's going to be a gradual one. And then we had the meeting yesterday when Powell was testifying in front of Congress. He struck a little bit of a hawkish tone. So yields have really shot up in these last couple of days. But there's one important thing that I want to talk about, and I honestly don't think it has too much to do with the taper right now. All right, all the talk on Wall Street is about the taper and when are they going to taper, right? Because the Fed has been buying $120 billion a month at least of Treasury bonds and mortgage-backed securities for the better part of a year and a half. And when they say they taper, that means they're going to slowly draw down the amount of buying they're going to do. And the Fed is probably the single largest buyer of Treasury bonds, so that is a big deal. But that doesn't explain such a big jump so fast. All right. Now, I think there's two things that are driving this big jump. Number one is inflation. Okay. I think people are starting to realize that inflation is not going to be transitory. Now, keep in mind, up until like the midsummer this year, most people who were polled didn't think this inflation was going to be a permanent thing. Most people thought they were buying Jay Powell's line that inflation was going to be transitory. I think the market is starting to realize that that is as ridiculous as probably most of the people who watch this channel realized how ridiculous it was. But that idea wasn't very mainstream, all right? The idea that inflation was here to stay was not a mainstream idea until very recently. And once people believe that inflation is here to stay, they start to demand higher interest in exchange for their loans. And you're starting to see that play out in the bond market. Now, that's one thing, all right? And we're also kind of seeing that in energy prices are on the rise. People are starting to realize this inflation story is not going away, that Jay Powell and his transitory narrative was really just feel-good talk, and the reality on the ground is something very different. But here's the main driver that I see, okay? This is my theory of why interest rates are on the rise. I think it has to deal more with the Treasury general account and the debt ceiling. Now, not the debt ceiling in that, oh my God, if we don't raise it, we're all going to die, all right? Because they're going to raise it. All right, it's not the prospect of a failure to raise the debt ceiling that I think is driving interest rates higher. I think it's the certainty that they're going to raise the debt ceiling that is driving yields higher. Now, what do I mean by that? Let's look at the Treasury general account real quick. We have to shrink my fat melon of a head again. All right, here is the Treasury General account. This is Aunt Janet's checking account, all right? And she has been spending this account down all year. This is all the money that they printed last year that the government borrowed. The Fed printed trillions and trillions last year, and then the Treasury borrowed it from the Federal Reserve. That hasn't been going on really for the better part of this year. They've been spending last year's borrowed money, last year's printed and borrowed money. They haven't been borrowing new money this year because the debt ceiling has been back in place. They're not allowed to borrow any more money. We're actually way over the debt ceiling right now. Remember, they didn't raise it last time. They just suspended it. So the government can't borrow right now. And if they can't borrow, they can't issue new Treasury supply. All right. Now, we're going to get into bond prices and bond yields. Remember, prices and yields are inversely correlated. Well, since there has been a limit of bond supply, the prices of those bonds has been going up because the demand has been very high. Well, high demand, low supply, that means prices go up. That means yields go down. And that's what's been happening for the better part of a year, right? I mean, yields are near zero. They're historically so low right now. Well, what happens as soon as that debt ceiling gets raised? As soon as that debt ceiling gets raised, Aunt Janet is going to start borrowing again. She's going to start making new Treasury bills, more Treasury bonds, selling them on the open market. Well, what happens all of a sudden when you have this massive new supply of bonds hitting the market when demand stays relatively flat? Well, more supply, less demand, price goes down. And that's what we're seeing in the bond market playing out right now. This is the bond market front-running new supply that is about to enter the market once the debt ceiling gets raised. Because once the debt ceiling gets raised, government's going to start borrowing hand over fist like crazy. All right? And on top of that, you've got the $1 trillion bipartisan infrastructure bill and the $3.5 trillion whatever human infrastructure wish list spending package, trillions and trillions of new spending. Well, if any of that passes, that's all going to hit the bond market too, and that's going to be more supply of bonds hitting the market, further driving bond prices down and yields higher. So that's what we're seeing playing out in the bond market right now. It's not the risk of imminent collapse of the whole global economy and the prospect of them not raising the debt ceiling. It's the near certainty that there is a massive amount of new bonds that are about to be dumped into the bond market. And prices are starting to drop and yields are rising, anticipating that new supply hitting the market. And real quick, I just want to point out while we're here, because it's also related to this issue, is the reverse repo situation. Okay, reverse repos hit a peak recently, $1.365 trillion in reverse repos. Now, reverse repos is also related to a shortage of supply in the Treasury market. Okay. One thing we have is banks are awash in cash right now, and our money is liabilities for the banks. So the banks need to hold a certain amount of collateral, i.e. Treasury bonds, on their books to offset our cash. Well, our cash is at all-time highs right now, and there's a shortage of Treasury bonds because the government hasn't issued any in a long time because they borrowed it all last year. So they've been dumping and temporarily parking our cash over at the Federal Reserve to the tune of over $1 trillion a night, and they've been borrowing collateral from the Federal Reserve. Well, once the debt ceiling gets raised and all of this new collateral hits the market, you're going to see this problem start to go away. You're going to see, once the debt ceiling is raised, you're going to see a step down and a gradual decline in reverse repo usage as more and more treasuries hit the market and the banks have more and more collateral available and they don't need to park all that money at the Fed overnight. I also want to point out that it is right now, September 29th. We are at the end of the quarter. So for the next day or two, you're going to see a massive, massive spike in reverse repos as all of these quarter-end transactions hit the books all at once. Just like we saw at the end of June. You see this big spike at the end of June here, where we went from around 750, 800, 900 billion. All of a sudden, we spiked to almost $1 trillion. And then it came back down. You're going to see something like that in the next few days as these quarter-end transactions pile up and the books balance out and rebalancing happens. You're going to have a lot of money moving around. We'll see a big spike in the reverse repos overnight. That's not any reason to panic. I think we all expect that. And considering the fact that you've got the debt ceiling is going to be raised very soon, flooding the market with new collateral, I think that spike is going to be kind of like the crescendo, the grand finale of this reverse repo story, and then it's slowly going to go away, and that'll be it. All right. So, guys, that's all I got for this video. Again, I don't think these increases in Treasury prices, I don't think this has anything to do with the imminent collapse of the global economy because of a failure to raise the debt ceiling and a default. I think it's just the market pricing in the reality that all these new bonds are about to hit the market and prices are about to drop and yields are going to go up. I also want to add, this is not good news, very bad news for the housing market, okay? Because house prices are at ridiculous highs right now. And I've mentioned on this channel several times that the key to home prices is affordability, not necessarily home price, but affordability. Can people afford those monthly payments? And the biggest input to those monthly payments is not necessarily home price, but interest rate on that mortgage. Okay, so if we see interest rates continue to rise and continue to rise, then borrowers are not going to be able to support these higher prices in homes because their monthly payment will be out of their budget. So keep in mind, as these yields rise, we may be getting near a top in the real estate market. We may be very close to that real estate market top. So that's also something to watch. Guys, I want to thank you for your time. Thank you for watching this video. Please remember to smash that like button, subscribe to my channel, hit that notification bell. Helps me out, helps me to keep this channel growing, keep this content flowing. In the meantime, live small and dream big.